So you want to build that $1 million portfolio. It's a pretty lofty goal, but when you go through planning and really looking at conscious efforts and a long-term goal, it is pretty easy to get there with some planning. Now, me personally, I've built over $1 million portfolio and continue to grow that portfolio with these 13 wealth strategies that we're going to be looking at. Starting with our first one, start with a high yield savings account. This is going to be that first $1,000, that first $3,000, the 3 to 6 months when it comes to an emergency fund. Starting with a high yield savings account offer you at least some return on your funds. It's not going to make you rich, but it is the absolute foundation of any financial strategy because this is where you're going to keep money. Now, me personally, I do utilize M1 Finance. I have a link right down below. Definitely putting the money in the high yield savings account is going to give you, as of today, a 4% return, which is pretty decent in the marketplace. Now, the second one we get into is leveraging compounding interest. This is the methodology when it comes to 401k plans, when it comes to IRAs, consistently making contributions in there. Albert Einstein has called it the eighth wonder of the world. Compounding interest takes your money plus your contributions and compounds it. As your money grows, it creates more money. This is how you get to generational wealth. When we think of someone like Warren Buffett, a majority of his income or majority of his wealth was built after 65 years of age and continues to build exponentially due to the compounding factor that we do have in there. Now, when you look at $500 a month at an 8% return, returning $1 million would only take 35 years. So if you can do that, even regardless of what age you're at, $500 a month, 8% return, compounding is going to give you just north of $1 million, and that $1 million portfolio is created. Now, third one we get into is 401k match. Employers offer a 401k match. There are not very many that do not offer anything at all. Roughly 3 to 5% is the average, and you are getting 100% return. They are going to match that certain percent of your income. Let's say that $200 is 5% of my income. They are matching that 5%, meaning I put in 200, they put in 200. There we go. You can make a lot of money on this. Then when you couple on the compounding factor we just talked about, it really sends it to the moon, being able to not only retire, but having the wealth and having the tools to get there. The next one we look at is diversification with index funds. Index funds, ETFs, are my absolute favorite. When you start looking at something like the S&P 500, very low expense ratio, industry-leading returns, around 10% on an annual basis, as an absolute must-have in the portfolio. This is the reason why I invest holding 35% of my portfolio in that S&P 500. It is a very simplified investing strategy. Instead of just buying, different stocks within the index, you just buy the entire index itself. With that, you can also explore alternative investments. Now, for me, this looks at peer-to-peer lending. It could be fine art, cryptocurrencies. This really exponentially generates additional portfolio and additional exposure on something that is a little bit more risky, but can also have a much, much higher return. Now, me personally, when it comes to these alternative investments, I invest in cryptocurrency. I don't do the peer-to-peer lending. I don't do the fine art. I also do not do the real estate investing. I invest in cryptocurrency. 5% of my portfolio is invested in IBIT. So it is in Bitcoin for that 5%, really having the balance between the growth opportunities and the risk that we want in here. Now, when we talk about risk, considering real estate investments, this is one of the most wealth and really lucrative tools that we have. However, it does come with a lot of risk. When you start thinking of rental properties, house flipping, investing into real estate investment trusts or REITs, really good because everybody needs housing. But I also feel like I don't know enough about it to really explain and buying into REITs and seeing what is really the best way to do this. Because for me personally, I will not own rental properties. I choose not to. I will not own house flipping. I don't want any, the time and effort that goes into that. REITs would be the only way that I invest. Now, I have invested a little bit before in Fundrise, which is pretty much REITs in its entirety, using both the real estate market, the industrial market, the commercial market, and without having to purchase the property outright, which is what I do not want to do. REITs could be something you could absolutely explore. Now, next one we get into is automating your investments. This is huge. It eliminates the emotional bond that you have with the financial planning and promotes uniformity in here. When you look at Betterment, when you look at Wealthfront, when you look at M1 Finance, you can use and just invest into really Vanguard funds going in there, which are very cost efficient, investing in the entire market with something like the VOO or even the VTI, which is the entire United States market. You could even go out globally to invest in everything within the market or really within the world itself, which is kind of crazy. You can automate it. You can kind of set it and forget it. Once you have the portfolio, as long as you're making consistent contributions in there, you can get that in. Now, number 9, we look at is rebalancing the portfolio. Now, honestly, the market fluctuation can shift assets, and I don't like it exposing your portfolio to unnecessary risk. Now, this is a little bit more of a controversial point because I know Vanguard, a couple of the CEOs have said there is no reason to rebalance your portfolio on a regular basis because essentially what you're doing is you're taking an asset that has generated or that has grown to a certain point, selling off that asset when it has been growing to invest in an asset that is underperforming. I can see slowly, maybe through dollar cost averaging, rebalancing into something that you want to. But really, as you're getting closer to retirement, rebalancing a couple percent kind of here and there, maybe having a little bit more risk. But a lot of studies have also said that if you're not taking the risk or if you're cutting out on some of the risk during your retirement years, there's a possibility if you don't have a large nest egg that you could actually run out of money. Next one we get at is the side hustle. That is the reason why we started doing YouTube. I actually take all the revenue that is generated from YouTube, put it into an investment account, and that is where I park it every single month on a monthly basis. Side hustles typically pay about $1,122 every month, which means achieving and getting those financial goals. Could be retirement, could be debt repayment, could be really anything. Looking at, some of the freelance online stores, looking at YouTube, social media, looking at selling things. There are so many things that you can do to increase your net income while not increasing your expenses is the very, very strong. And when it comes to really increasing your net worth personally, investing in yourself and your education. When you land on a place like here that has financial education and literacy, continuous learning allows individuals to make smarter decisions. But having certifications, advanced degrees, reviewing publications, networking with individuals, there are so many different ways where you can get out and make additional income and really increase your value in the workplace, allowing you to earn more money when it comes to promotions, when it comes to jobs. Now, of course, the final one we're going to leave you with, review and adjust your strategies on a regular basis. Financial planning requires consistent attention and adaptability. If you're going to change your portfolio, make sure you know exactly how you're going to do it. This is just like budgeting. We do budgeting on a monthly basis, going through, changing up the approach, making sure everything is still in line with the plans that you had when you started the plan. According to the Wall Street Journal, evaluating your plan every 3 months ensures that the personal objectives are right on target. Market trends haven't changed anything that you need to, and staying proactive with these reviews really make a big difference when you want to keep your financial goals on track. Now, of course, when we look at all this, guys, tax advantage accounts, retirement, consistent contributions, looking at, your IRAs, your HSAs, your 401k plans, making sure you're maximizing those retirement vehicles will give you the ability to not only save money, have that compounding interest, putting money in that high yield savings account. Make sure you're taking advantage of anything that is related to the tax structuring, because any place that you can save money, trust me, in the long run, it is going to save you a lot of money. So, all right, guys, so those are the wealth strategies to build that $1 million portfolio. For a lot of people, it is an absolute goal to hit into that 7-figure mark. Very cool to see. And when I first crossed it, pretty impressed with everything that we've accomplished. And honestly, when it comes to net worth, calculators, I do exclude the mortgage. I've said this before. The reason being, even if your house is worth, let's say, $500,000, you have that asset, but you still need a place to live, and you can't really have that asset or appreciate the value of the asset until it is sold. So make sure, guys, how you're doing your calculation of your net worth. A lot of people do it, everyday millionaire. Some of the numbers can be very skewed because of how high the housing market is currently. But guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.